This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the very first SMSF Adviser Show for 2024. It's weird saying that. I'm your host, Keith Ford, joined as always by my co-host, Aaron Dunn from Smarter SMSF. Welcome and Happy New Year, Aaron.
Happy New Year to you too, Keith. How are you?
I'm doing very well. It's, I wouldn't say great to be back, but, it's good to be back.
Yes, and I'm sure many people will be enjoying a much bigger break than we're currently having, but it was good to have a bit of a break nonetheless.
Always good to get a little bit of downtime, a little bit away from the grind in the office and all of that and spend some time with the family. It's good times.
Yes, and I have the joy at this time of year of getting presentations ready for the SMSF Association National Conference. So, it's kind of got my head down, bum up with a lot of that stuff, but also having a little bit more of a break as I get closer to Australia Day too.
Right. Well, I mean, you're a sicko for this stuff. So you would have just been doing that the entire break. That's your downtime, surely.
Yes, pretty much. So, well, today we're going to talk a little bit about the year ahead for 2024 and what we see as the challenges and issues shaping the SMSF sector.
We are. So it's 2024, which is very weird to say, but there's lots on the agenda, of course, coming off the back of a very busy 2023, particularly for the SMSF sector. There was a lot of different changes announced, a lot of different legislation being introduced in either a draft form or something a bit more concrete. And 2024, we kind of expect to be a bit more of the same, where there's lots that's still left over that's going to be coming ahead in the year to come. So I thought to kick it off, we were going to touch on the retirement income covenant and how that relates to SMSFs and the idea of, whether the government's trying to kind of disincentivize a little bit the role of the self-managed super fund.
Yeah, well, I think naturally we've got the government and we've seen Treasury roll out a discussion paper around retirement and the importance of retirement. And I guess trying to sharpen the focus on retirement policy and what that might look like for the industry. Quite interestingly, SMSFs have probably north of 40% of clients already in the retirement phase. So it has led the way in this area. But the government has naturally asked the question here as they look to, I guess, the outcomes of this and through consultation of this retirement income policy and more broadly, how the retirement income covenant fits into this. Should this retirement income covenant actually have a role to play within the SMSF sector? And that was something that was originally asked before this was legislated from the 1st of July 2022. But ultimately, there were a number of concerns raised, including timeframes and so forth, that we saw the government quickly remove SMSFs from that landscape. So I personally think there are some problems, but some benefits with that retirement income covenant for SMSFs. So if it was to operate successfully, it would need to ensure that it didn't overlap with a range of other things like the investment strategy requirements and so forth. So there might need to be something that's a little bit more specific to SMSFs. And we have seen legislation that has been carved out very specific for SMSFs, and non-arm's length expenditure is one example of that we saw in 2023. So there's certainly elements that the government, when we look back, appear to be trying to disincentivize SMSFs. But in this instance, I think, there is an opportunity to maybe look at the positive elements out of this and see whether they can apply, but we can't really try and fit a square peg into a round hole as some of that retirement income covenant would potentially do.
Yeah, and it's been part of a very broad government incentive they've been looking at a lot of different areas within retirement and trying to make sure that people are cared for in their later years, I guess you'd phrase it. And this is kind of one of those ways. And there's certain things within an SMSF, because they are so much more engaged, generally speaking, the members of an SMSF, it does kind of lend itself to already kind of being a bit better prepared for retirement, essentially, I guess.
Yeah, and even the ATO in their language to establishing funds talk about the importance of setting up an exit plan. And I know from memory, I recall, a lot of the discussion, the good elements of it were identifying things about what you're going to do in succession and in the event of death, and making sure all these elements are tied up and not waiting to happen when they happen, but planning for these things well in advance. So to me, I think there's an opportunity to, if we need to formalize those in some way, shape or form, maybe there's an opportunity to do it. But the language is already fairly embedded into the industry, in particular because of the fact that we have so many Australians in self-managed funds that are in that baby boomer and later stage of life.
Yeah, absolutely. Now, the next topic, it's one we've talked a lot about, often looking at it from the side of what's been going on. So now we're going to look a bit towards what's happening in the next coming year. This is, as no one will be surprised, Div 296, the $3 million super tax. Believe it's meant to be heading to a Senate committee to report back in April. Do you expect much in the way of changes to the framework that has been set up to come out of these kind of hearings and further consultation?
I'd like to hope so, but I also, in the equal sense, don't hold my breath. So what we did see in the last sitting of Parliament before Christmas was the fact that this, in essence, went straight to a Senate committee for further review. And naturally, that opens up an opportunity for the industry to again consult and potentially present before the Senate inquiry about the concerns that have been raised. So at this point in time, we don't have anything other than the bill, and naturally there'll be a lot more to come out within the regulations. So hopefully between now being the start of the year and the time that that inquiry happens, we might get some more information around the regulations and how some of these things might actually work. So from that point of view, it will be quite interesting this first half of the year to see what transpires and whether there is any appetite from crossbench senators to look to some form of change. Now, quite clearly, the two bugbears of the industry have been around the unrealized capital gains and the indexation. So it will be quite interesting to see, how those crossbench senators approach this. And as is always usually the case, it may end up in some form of negotiation to ultimately get the legislation through.
Likely the case, yes. It's definitely seeming as though that crossbench is where things are going to need to change if they are going to change, as is, I guess the entire point of the Senate having that kind of breakdown is so that there can be these concessions made and working towards the best version of something. It's hard to know whether there's going to be much in the way of pushback and movement. Obviously, on the side of the Liberal Party, they're obviously not going to do the government any favors and rushing anything through the Senate. But there is obviously a lot of people on the crossbench that will have a bit of say in this. Yeah, I'm not very optimistic, basically, that many of these changes are going to be, the concerns of the industry are going to be taken on board.
So the other thing that then starts to present itself, if we're not seeing any sort of response on this from a report back to the Senate until April, then are we going to see legislation get finalised before the end of the financial year, which therefore means you then have less than 1 year for individuals to get their house in order if those laws in its current form were to take place. So then it poses a real problem in this first half of the year because a lot of people are wanting to start planning with these changes. And with uncertainty, you just cannot plan for the changes that may or may not present in their current form. And things like unrealized gains being included or excluded is a significant enough issue to determine what actions someone might take. So this is the problem. The longer that we get into 2024 without any resolution, the more problematic that a 1 July 2025 start date becomes as well.
Yeah, it's not exactly tinkering around the edges.
No, we're not dealing with tens of thousands of dollars here. We're dealing with fairly substantial and lumpy transactions that will occur. And giving those people sufficient time to respond to these law changes is that people might argue that they've got a lot of money, it shouldn't matter. Well, they still have a right to be able to make some informed decisions around their affairs with adequate time.
Yeah, absolutely. And so I guess then the question becomes, does it still become implemented at the time that it was supposed to? So will the government go ahead with that 2025 financial year start date? Is that something they'll continue with? Will they want to push it back further?
I was just going to say, we come into an election then.
That was exactly where I was going, Aaron. Yeah. Being that there is that federal election coming up in 2025, possibly late 2024, it can be done earlier, but, you would expect around May 2025, I believe. They would want to have it legislated, basically, if this is what they want, so that it then isn't going to be immediately repealed.
Yeah, it's the same set of circumstances as the former coalition government introduced all the different tax cuts. So we're in this year about to go into stage 3 of those tax cuts, but they were legislated before. So the only way in which they would be able to be changed is through the government having to repeal them. And I think that's a lesson that Labor learnt from the coalition government, and therefore are trying to repay the favour with these Division 296 rules, which of course the coalition have said if they get into government again, they would look to repeal, but it would then come back to how the Senate might look, for example, for those to actually make that happen. So there's a very calculated move here by the Labor government to try and get this in, noting that once stuff's in, it becomes very hard to pull out. And again, I refer to those stage 3 tax cuts as well, which have become very topical for 2024.
Which we may as well swap over and start talking about the stage 3 tax cuts. As you mentioned, they are going to be going into effect on 1 July 2024, correct?
Yep.
All right. Yes, got to get my figures correct there. The stage 3 tax cuts essentially bring a much wider swath of the population into the same tax bracket. I believe 45,000 to 200,000 become a single tax bracket, which is obviously a lot wider than what we've got at the moment. So can you give us a little bit of a rundown on how these tax cuts are going to affect things?
Yeah, so the long and the short of it is effectively we're going to see a fairly sizable cohort of individuals getting much greater income available to them. And it is far more beneficial to those on higher incomes than it is to those on lower incomes. But the reality is it is going to open up opportunities for people to be able to look at what they might do with that money. Is it the opportunities potentially for further contributions into super if they're not already fully utilising things like their concessional contribution cap? But as we know, there is a lot of debate and discussion around this, and naturally because of what appears to be the distortion of the tax benefit being derived by higher income earners than those that may be doing it a little bit tougher than others at the moment. So it will be interesting to see whether the government really holds steady on this or whether they may look to a change. The flip side to that is if they don't make that change and they carry through with that, well, could they look at potentially some form of recovery through maybe a reduction in the Division 293 tax, where the threshold might be $250 currently, and they might then drop it down to, say, $200,000 and match those two items out. So there's a few ways that the government could go here, and some of this could ultimately be subject to announcement in federal budgets and so forth as we, again, move into the first half of this year or back half of the financial year.
Yeah. And as you mentioned, it is the higher end of these earners that are going to get the greatest benefit from it. Yep. So people who are earning between 120,000 to 200,000 pretty much are going to be the greatest beneficiary there because their basically their tax bracket is dropping.
Yep.
In line with the lower earners. Politically speaking, it looks worse in a cost of living crisis than it did at the time that it was being legislated.
Yes, correct.
It does look, from an optics perspective, it looks worse, but, it is already legislated and has been for a few years now. That it doesn't seem, it could change at any time, but being that it's so close to actually starting, it doesn't seem likely that there'd be a repeal of it.
Yeah, and that's the same point I guess we were making before about the Div 296. Once it's in, it becomes very hard to remove. And where you don't have the control of the Senate, then the navigation of your way through to get those sort of things repealed will become very difficult. So therefore, is it Labor then might need to look at other levers that they could have available to them. And naturally, those sort of announcements would follow in the budget. But we know full well Labor have said historically that there will be no changes to tax policy settings within superannuation within this term of government. So again, we would potentially expect things like if a Division 293 tax threshold was changed, would that threshold then apply post-election as we moved into the 2025-2026 year?
Right. And I mean, we're moving seamlessly through topics here. You just brought up the budget. Why don't we touch on the budget a little bit? Now, it is, of course, a couple of months out. A lot can change, a lot can happen, but is there anything that you're expecting from the budget for 2024-25? What are we looking at?
It's a bit hard to say. I think some interesting indicators for me will be just the narrative we get from the government around the objective of super, because quite clearly, once that becomes legislated, the interpretation of the objective becomes an opportunity for them to look at different policy settings. So, will we see potential tightenings of things that are linked to housing policies, so first home saver super schemes and the like? And we know full well that the Division 296 rules appear to be very intrinsically linked to the objective of super, as we've discussed ad nauseum throughout most of 2023. So there are a number of things that the government could look at. What we would like to see in the SMSF industry would be two things. One is the item of defined benefit pensions, so the legacy pensions, the fact that the government previously had a 2-year amnesty to try and tidy these up. And as we are moving into the potential for the Div 296, there is an opportunity for those legacy pensions to potentially get cleaned up as part of this process before those rules kick in. And equally, we've seen the government previously announce the changes to the residency rules for self-managed super funds. And again, these are just some overhangs from previous budgets that would be great to get some resolution on as we move into the current year as well.
Yeah, and as it gets closer, we'll hear a lot more. But it can be hard to forecast what a government's going to do a week out, let alone a couple of months.
I think the thing that we do know is that the government will test stuff from now on into financial services media. So we will see things get thrown in and debated, like we did see at this time last year, conversations about whether there should be a $10 million limit in superannuation or whether there should be a $5 million cap. These were all things that were happening over the Christmas, New Year and January period that then pretty much kind of went from just a lit match to an actual bushfire that the government needed to put out. And they did that by the Treasurer and the Prime Minister announcing that introduction of the Division 2, well, wasn't Div 296 tax then, but what we now know as Division 296 tax. So, yeah, I think it would be interesting to just keep seeing what the government sort of drops out, and you'll get a bit of a read of the room as to what they are thinking. Submissions are naturally going in at this point in time from all parts of industry and therefore frame up what the government may look to do as we get towards that second Tuesday in May.
Absolutely. So, gnarly, gnarly. That's another one that we had a lot of talk about last year. We did manage to get to, some kind of resolution on these, but I presume that's not going to be the end of it.
Well, it may be. I guess there was a lot of hesitation there, wasn't there? There was a lot of hesitation.
It's tough to know what they're going to do.
Yeah. Because where did we get to at the end of the year? We got to, in essence, the Senate committee agreeing to the changes. But it didn't stop there, because some of the interesting things that came back on top of, well, let's proceed with these changes to the income tax rules and as an integrity measure for self-managed super funds and small APRA funds, is the fact that two of the senators raised the issue of whether we may need to go further from an integrity point of view and look at tidying up the arm's length dealings rules within the SIS Act, so Section 109. So that will be quite fascinating to follow, whether we think everything is done and dusted at that point and we move on in respect to that general expenses issue and the fact that it will be a 2 times multiple of that non-commercial arrangement that has occurred in the fund. But whether we see anything else beyond that, it would be nice to put this to bed is the short answer, because it has been going on for 5, nearly 6 years. So getting some closure on it so we're actually not talking about it would be a nice outcome to achieve.
Absolutely. So we might have one last topic, the QAR. There was a lot of news at the end of the year. Minister Jones had promised to get some information out before Santa Claus came down the chimney, and he certainly did do that. We had a big breakdown of all of the QAR measures on the IFA podcast, but we haven't really gotten any of your thoughts on what's happened. The big things were banks, insurers, super funds. They're going to be able to employ advisors, what's at the moment termed a qualified advisor, which is a term that many advisors have been quite upset about. I think fairly reasonably so.
Yes.
It's certainly a bit of a confusing term. They'll be able to employ these qualified advisors. No one can see my air quotes, but I am doing them.
Yes.
They'll be able to employ these qualified advisors who will not be allowed to charge fees or commissions. They will just be salaried by the employer, super fund, insurer, bank, whichever institution they fall under, and they'll have a limited scope of some kind, and they will have education requirements of some kind, diploma perhaps. Again, all a little bit uncertain on those details at the moment, but there were a lot that came out from Minister Jones's announcement at the end of the year. So if we could just get a few thoughts from you, Aaron, on where you think it's heading this year and whether things are going to stay as based on the announcement.
Yeah, so I think I probably fell into the camp of most, that we ended up seeing that much announced at the end of the year. So I think that was a bit of a surprise. And I know you were in Canberra for the announcement at that time, and you were probably rightly surprised by the amount that was ultimately released.
I was there thinking, we'll get the info on the second tranche, as they've been terming it, and then, nope, here we go, everything. Here's the rest.
Here's the rest. Yeah. So I think getting that clarity, given that it had dragged on for so much time, had been a positive. But the interesting thing, of course, was this concept of the qualified advisor and bringing, in essence, the banks back into the equation in a sort of an equal footing to the way in which they're looking at super funds, industry funds and so forth, and those qualified advisors with talking marks again in the air.
Got to get the quote marks.
Yeah, and the thing, I guess, that I still find staggering as well, and yes, I do wear an accounting hat as well here, is that we do have, and I use the word suitably qualified because this is not open. I don't believe this should ever be open to all accountants to do so, but there is a cohort of accountants out there that would be suitably qualified to be able to also fall within a limited framework of providing advice to self-managed super funds and so forth. Yet again, they just appear to have been washed away to the side and getting no resolution on. So there's an element of frustration that's sat with that for some period of time. But I think, the bigger issues are just that delineation of what is a qualified advisor. When the financial planning fraternity has spent so long trying to, get it enshrined in legislation about what they are and what they stand for as a profession, and then to kind of plug and play this junior in to be able to provide advice and so forth, it just doesn't really sit that well. So I think, those things are frustrating. The removal of SOAs and all that sort of stuff is going to be fantastic, right? But there just appears that all appears a bit jumbled at the moment. And hopefully as we move through this year, there'll be some better clarification around terminology that might appease some, and we get a better understanding of what advice might look like and whether that actually does open up the opportunities for advice, because that's what it comes back to, right? We need to open up the ability for people to get advice in whatever form or structure that they have their retirement savings in. And that, to me, is where we need to focus on and get the right settings. And if it means industry funds have to play a role, banks have to play a role, so be it. Advisors need to play a role. I'd like to see accountants form part of that role somewhere as well. And we move forward.
Yeah. Hopefully they change the name.
Yeah.
It's not, it's not a fix to everyone's problems, but it is one of those kind of easy fixes where you've put this out and it's gotten pretty universally slammed, I guess.
Yeah.
I don't know that anyone's really a fan of the phrasing there.
Keith, I'd be interested. What's the best sort of reference that you've seen, obviously, in a lot of the comments and discussions that have been had around that sort of qualified advisor to a financial advisor in a different context?
We did get a lot of those when the announcement originally came down. We got, I might go and see my qualified doctor, referring to a pharmacist, might head down to Bunnings, get something installed by one of their qualified electricians. There are a lot of them around that kind of area go and, get my blood pressure taken by a qualified doctor and it's a nurse and, all things around that. There've been some pretty interesting ones on that front. I do like the qualified doctor being a pharmacist. That one was pretty good.
Very good.
Yeah. And it kind of works in that they're able to, do limited things in they can talk to you about what might be good. They can do things over the counter, but any of the hard stuff you need a script for from an actual doctor rather than a pharmacist. So,
yes,
there's a clear scope that they've got there and everyone understands it. So I guess that's the ideal is that, if we can get somewhere where there is a clear scope, consumers that are going to these people understand what that scope is and understand that they are not giving just holistic advice. That's the key. They need to understand they're not getting full scope advice. They're just getting it limited to this, and so, hopefully there's a bit of a terminology change at minimum.
At minimum. I agree.
All right. Well, I think that actually wraps us up. There's going to be a lot coming in 2024, as there usually is. No one can leave well enough alone. Everyone's got to tinker, and that has flow-on effects. So there'll be a lot coming this year, I'm sure.
Yeah, I couldn't agree more. I think, this first half of the year is really going to be seeing the foundations of a lot of the things that were negotiated or talked about through 2023. Seeing the rubber hit the road, as we said, the objective, the QAR, we saw a lot of stuff get sort of really pushed in and jammed into the, right at the death end of 2023. And so therefore it is all going to kind of squeeze out as we get into 2024 here. And as I said, the rubber will hit the road on all of this stuff and we can really get our teeth stuck into what impact it's actually going to have on clients and on the industry in general.
Absolutely.
So, well, as is always the way, Keith, if anyone has any suggestions on speakers, topics, otherwise, how can they get in contact with us?
That's it. Editor at smsfadvisoronline.com.au. Send us anything you've got.
Excellent. Well, thanks again for joining us for what is our first edition of 2024. I hope you are either enjoying your break still or enjoying being back at work. I know we both are. So have a great rest of the week. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.